Hello and welcome to 3.0 TV and happy Diwali to all the viewers. Since we are talking about a record $19 billion in crypto bets that were erased and crypto prices that tumbled over the weekend, we have invited a special guest to discuss the entire scenario of the crypto market, although the market is rebounded. But to discuss this, all the intricacies in detail, we have invited Matthew Dixon, a veteran crypto trader as well, sir. Welcome on 3.0 TV.
Yeah, thank you for having me. Pleasure to be with you.
So Matthew, so let's begin the discussion with there was a bloodbath which we have seen in the crypto market. In not over 20 minutes, almost $20 billion worth of bets were erased, and crypto prices tumbled. And on the back of, there was a small announcement which has come from Donald Trump about the China tariff announcement, and a combination of factors such as the leverage automatically which triggered the sales, and a lack of liquidity at the odd hours of the global trading. So since we are talking about crypto market and the way forward, what is the opening remarks on this?
Yeah, I mean, as you say, it was a perfect storm of factors that came into play together. As you say, there was thin liquidity during the quiet time in the market. Obviously, there's a lot of leverage built up because people started to treat this as a one-way bet. But in fact, obviously, markets go both ways, of course. And even in a bull market, there are retracements. And I think this is probably just a normal and healthy retracement or correction in the market, a consolidation before probably the next move ahead. So obviously, it was a big shock announcement that Trump came out with the tariff announcement on China. They already had 30% tariffs. He threatened to increase a further 100% tariff on China. And this was a major shock, obviously, to impact world trade and risk assets. And so the market sold off very, very rapidly. And as you say, leverage, and anybody who is leveraged, these platforms sometimes allow up to 100 times leverage. And if you're just 2 or 3 times leveraged on some of the assets, you'd been completely wiped out. And this is what caused the massive sell-off. But I think the backdrop remains strong. The environment is good. The ETFs inflows are still good. We've got new ETF announcements due to come soon, probably after this government shutdown is resolved in the US. But once that happens, there'll be more announcements, perhaps Solana, perhaps Litecoin, and others. And if that happens, there'll be a lot more capital flows into the market. And I think we're set for another pump to the upside on the crypto market.
So, Matthew, you spoke about leverage and the 100 times leverage bets. We will speak about leverage in detail, but the broader concern was of the sell-off. Impact was a wide range, and I'm talking about the Ethereum USDe, the third largest stablecoin that briefly lost its dollar peg. And on a second count, the Binance, the largest digital asset exchange, experienced technical glitches, wherein overall, roughly around 1.6 million traders were liquidated, which is according to the CoinGlass data. So how do you see this situation? I mean, ups and downs are part of markets, financial markets. But at a time when there is a sudden drop because of the over-leveraged position, if such situation will continue in the market, you think there should be some checks and balances that should be in place that will avoid such kind of crash and situation?
Yes, I think crypto is still very much an emerging marketplace. So we know about emerging markets. We've had them before. Asia used to be an emerging market. Now it's very much more mature. Same with crypto. There is still a lack of liquidity, particularly at these times of stress in the market. We were in a situation of relative greed in the market. As I say, everyone was thinking it's a one-way bet, and then it suddenly turned around,
right,
and extreme fear pervaded. And when this happens, so you're absolutely right, there needs to be more checks and balances. And we know that crypto regulation is evolving as we speak and advancing, and they're recognizing that crypto is here to stay. And so regulations perhaps need to catch up to ensure there are proper protections in place for the traders, for retail traders, for everybody now who's starting to see crypto as a potential investment within their portfolio, within their pension fund, whatever it might be. It's now a mature or a maturing asset and needs to have more and more checks and balances in place to protect the consumer.
But Matthew, since we are talking about the big picture of stablecoin to touch $1 trillion going forward, Ethereum lost its peg, and how encouraging is this situation for the entire stablecoin industry? Because we are seeing PayPal's of the world, Mastercards of the world coming very hard on the stablecoin sector. So how do you think this sector will impact the consumers or the companies going forward?
Yeah, I mean, it is a slight concern. We've seen this in previous market crashes. So, for example, when we saw Terra Luna, if you remember that crisis a few years back now,
the algorithmic stablecoin.
Yeah, we saw a depegging of stablecoins back then. And again, it's only just over a year ago, we saw the FTX crisis. And again, stablecoins depegged. So there needs to be this issue needs to be addressed by regulators. They need to absolutely ensure that there's proper backing behind these stablecoins. So that does need to be addressed, as you say. It's basically a chink in the armor. It's a risk that needs to be addressed, and regulators need to focus on these issues because these are the backbone of the market. It's where everybody goes to in times of trouble. They come out of risk assets, they go into stable coins at the moment. And stable coins, as you say, are being used so much more widely within the economy, with credit cards and so on. It needs to be addressed. You're absolutely right. And I believe it is being addressed by the regulators.
All right. So from stablecoin, let's move on. The kind of trouble which we saw in the market was full on display on the exchange called Hyperliquid. We have discussed in detail, Matthew, in our last discussion as well. Despite being a smaller rival to Binance, Hyperliquid experienced the most extinguished trades in dollar value during the 24-hour period sell-off last week, which is $10 billion according to the CoinGlass. So how do you see this concentrated type of approach that we have seen in the Hyperliquid, and what are the takeaways? I mean, since we are talking about long-term investment from here on, how such situations and such tokens can be avoided, or should we bet on? What's your view on that, Matthew?
The likes of Hyperliquid being a decentralized exchange is becoming more and more popular. And there is a big concern, actually, over this sell-off that there was. You may have noticed on a decentralized exchange that there was a big bet, a short set in the market just 30 minutes before the big sell-off, before the Trump announcement.
Exactly.
And there's a massive profit made from that. And the thing is that players who want to play the market in this way, especially if they have effectively illegal inside information, they will play the market on the decentralized exchanges because there's no KYC involved there. They can't really be tracked. So the decentralized exchanges are becoming more and more popular for this very reason. And maybe, again, regulation needs to catch up a little bit. I don't think there can be complete anonymity for traders because we want to know who it is who's behind the big trades that potentially had inside information, which is illegal. And that regulators still need to catch up. There's a lot of catching up to do. And they shouldn't be reactive. They need to be proactive. They shouldn't wait for these things to happen.
Exactly.
They should be actually putting the regulation in place before it happens. So you're absolutely right to highlight these concerns. And, but Hyperliquid is a great product, is very, very popular, and really has a place in the market, has a rightful place in the market. But maybe regulators just need to ensure that the consumer is properly protected.
Matthew, I was reading a few articles wherein a risk management mechanism called as auto-deleveraging or the ADL that contributed to this sudden fall, wherein the exchanges incorporated, we spoke a while back on the thin liquidity and odd hours of trading, exchanges incorporated it to protect them from losses during the extreme market volatility. But many market participants also blame ADL for making the sell-off even worse. What's your view, Matthew, on this?
Yeah, I mean, exchanges, most of them actually take the other side of the trade. They're basically, effectively, when people lose, they actually take the other side of the trade and they benefit from it. But in extreme market volatility, sometimes you get some big players in the market that can put even the biggest exchanges under stress. So the last time we saw this sort of situation really was in the FX market. It happened during the Swissy against the euro. There's a massive exchange rate difference then, movement.
Yeah.
And that caused some of the big exchanges to actually get wiped out. So there do need to be protections in place for the exchanges. It actually costs money and it actually means there's less profit to be made by the exchanges. But this is a good thing. Exchanges shouldn't just have a complete one-way ticket against their traders. Otherwise, they've got an axe to grind, and it's not right that they should be trading entirely against their customers. So again, it's another issue. I do think exchanges need to be set up for worst case scenarios and protected for worst case scenarios, because at the end of the day, if an exchange were to go down, it's the consumers that lose. It's not just the exchange that goes down, it's the consumers. So these checks and balances, as you say, need to be in place, and it worries me if there aren't. And if it does exacerbate losses at times, I think that's a price worth paying to ensure the majority are protected.
All right. Since we're talking about a broad picture in the market and what is the way forward in terms of the opportunity which lies for the investors going forward, Matthew, the liquidations were concentrated on smaller coins beyond Bitcoin and Ethereum. Although they fell, but such as the altcoins, leverage tends to be higher and the liquidity much lower in those familiar names in altcoins, wherein we saw 30, 40%, 50, 60% fall. What is your advice to investors going forward? How should they approach this altcoin sector and the euphoria around it?
Yeah, it's quite interesting. When we watched the Bitcoin price moved a couple of years back now up to 69,000, and then the price fell sharply to the FTX low of 15,500. That was basically what I would call the retail phase of the market. We're now in what I would call the institutional adoption phase, where institutions are piling in, and that's why I've seen Bitcoin rise to a new all-time high, 125,000. So a lot of the capital is focused on the big tokens which have ETFs. Obviously, at the moment, we've got Bitcoin and Ethereum, and there's others coming, maybe XRP, maybe Solana, maybe Litecoin, and more will come as time goes on. So institutional money is focused on those, but the retail money is still focused on the altcoins, the smaller cap tokens, which have much higher volatility. And people sometimes ask me on my Twitter, on my X feed, is it safe to put 3 times leverage on a particular token? Well,
exactly.
There needs to be a lot more education, because 3 times leverage is massively risky. It would only take a 1/3 move or a 30% move in the market to wipe out their capital completely on that trade. And so there needs to be education about the risks of leverage. With these altcoins, the volatility is massive. And so I would not recommend leverage is really for professionals to use. And even then it's risky. And as I say, up to 100 times leverage is available on a lot of these platforms.
Exactly.
3 times can wipe you out. 2 times can wipe you out. If you've been leveraged 2 times on XRP this weekend, all your capital would have been wiped out if you've been leveraged long on XRP at just 2 times leverage. So on a major token like XRP, it just shows you the sort of risk involved. So I would personally say, probably, unless it's capital you can afford to lose, then if you can afford to lose it, by all means, leverage, gamble effectively the way you want.
Fantastic.
But if you're actually using this as an investment, I think probably just go long only and don't leverage, because the outlook for the future for a lot of these tokens may be positive, but we don't know what sort of severe pullbacks there might be.
But Matthew, that is about the trading perspective. Is there any suggestion for the long-term investment? And what is the definition of long-term investment in crypto as well?
Well, one of the keys to investment, and this actually came from a Nobel Prize winner, was diversification is the key to successful investment. So in other words, don't put all your eggs in one basket. Don't just go for your favorite token. You actually need to select tokens which are not correlated. Mm-hmm. In other words, for example, correlated tokens, you might look at Ethereum is actually very tightly correlated with Link, with Chainlink, for example. And other tokens have tight correlations. And so you would avoid having tokens with the same, that are correlated together in the same portfolio. So you need to do your research, do your due diligence, diversify across tokens which don't always move together. And not just in crypto, you need to diversify into other assets as well. Gold, of course, has been a great safe haven where people flock to in times of trouble. It should be part of any well-diversified portfolio. So diversification is key. In terms of timeframes, how long should you invest for? Obviously, those are very, very personal questions. We do have what's known as a 4-year cycle within crypto in general. So Bitcoin has a 4-year halving cycle, approximately. and markets tend to move up and down within those 4-year cycles. So I would suggest that a reasonable time frame, if you're talking a long-term investment, I think you should still be looking at a minimum 5 years potentially as a long-term investment if you're looking to buy and hold crypto. But if you're looking to actively trade, then again, you need to adjust your risk and your reward parameters. So successful trading is about managing risk, understanding what the potential downside is. Don't always look and dream about how much you're going to make. Look at what's the downside potential as well. So you need to weigh both sides up and understand how much capital you could potentially lose. Are you comfortable with that? And then you can actually structure your portfolio accordingly. So just to summarize, it's diversification. As you say, it's time frames. And if you get those, and it's lack of leverage, I guess, you shouldn't leverage. So overall, I say you shouldn't leverage. You can if you can afford to lose the money, but otherwise, if you can't afford to lose it, if you're looking at proper investment, then diversification and time are the key. So timing is less important than timing the market, they say. So if you can afford to stay in the market, it's less important than timing, because we can never tell where the up and the down in the market is. So if you're jumping in now after the fall over the weekend, don't be, you can't be certain it's going to rise immediately. You may just have to hold that investment for some time. We don't know. Nobody knows, not even the professionals. But what the professionals do know is how to manage risk, and that is the key to successful investment.
All right. So one last question, Matthew, before we let you go. Has it spoiled the market sentiment and the way forward for short-term, long-term investment? Because the funding rates, which is the interest paid to the bullish trades, to take on the leverage for the leverage bets for the futures, have plunged to the lowest level since around the time of FTX implosion in 2022. We also spoke about how leverage can be dangerous for most of the traders. The most severe leverage which was seen in the crypto history, and which is the CoinGlass research has also mentioned about several factors, pros and cons about it. What is your suggestion for the retail investors, Matthew, and which are the safe haven investment tokens according to you that will be in the forefront going forward as well?
I think we need to just look and listen to what's actually happening in the market. So if we look at ETFs, for example, we had the Bitcoin ETF, and we've seen what's happened to Bitcoin price since then. We've had the Ethereum ETF, and we've seen what's happened to Ethereum price. So I think when you get an authorized, regulated ETF, then it means that a lot more capital from the institutional markets can flow in. So individual retailers can actually invest into the ETF, and that ETF money is, it can flow into these ETFs. So I think as a good sort of rule of thumb might be to look at what's likely to get ETF approval. And as I said, Solana is likely to be, one of the next ones to get the ETF approval. Also possibly Litecoin, also possibly XRP. BNB is a good safe haven. So again, when you're looking at what's a good safe haven token, actually I try to look at what has utility, what actually has real use for the token. So the BNB token, for example, from profits that are made by Binance, they use those profits to buy and to burn the token. So that affects the factors that determine price, supply, and demand. When they buy their token using the buy, it obviously increases demand and reduces supply because they're buying the token out of the market, and they're burning it. So again, reducing that supply. So you got both the demand, and the supply being addressed both at the same time, which is an upward movement on the price. Usually that's the logical expectation. So look for utility. As I say, do your due diligence. Even as retailers, do your due diligence. Don't just take somebody else's word for it. If you're trying to make money out of this, it's a serious matter. So do as much education as you can to learn about which tokens have utility, which tokens are going to be useful for institutions, because institutional money is, there's trillions in terms of dollars worth of institutional money which can flow into crypto. And more these days, we're seeing announcements that institutions are investing more into crypto. But there are also warning signs. So, Lansdowne, is it Hargreaves Lansdowne in the UK, are basically saying that crypto doesn't have any fundamental value. So there are warning signs as well. So you need to listen to both sides. Again, don't just be swayed by one side of the argument. Try to keep a balanced view. Look, and education never stops. So always keep listening into the market. Listen for announcements. Trump's announcement was absolutely key this time round. But also on the other side of the coin, announcements about ETFs could be very, very positive. So for me, I think if this government shutdown is basically averted or stopped, and the government reopens, then one of the first things that will happen is this ETF regulation. And I think Solana is one of the first. So I would say Solana is one of the relatively safe bets. But having said that, it's still a volatile token. Crypto is volatile. Even Bitcoin is still volatile. It's matured. It's come a long way. Probably still has a long way to go. So there's still lots of opportunity. Crypto is an amazing place of opportunity, but with opportunity comes risk. So balance it and do your due diligence, I would suggest.
With opportunity comes risk. That's all there is. Thank you so much, Matthew, for being part of this interaction. And I wish you all the best for the future going forward as well. Thank you so much, Matthew.
Thank you so much for having me. Thank you. Bye-bye for now.